a lot of times, even if you're invested into existing assets, you're dealing with a lot of the same issues. Like if I'm developing an apartment building and you're buying an existing apartment building, I want to know what you're looking for because I want to know how to build it so that it's attractive for you. The risk profiles are different, but the process is basically the same.
Real estate development. Real estate development. Land to legacy.
Yeah, what do you underwrite to in regards to what's an average capital amount you'd have to bring in for it?
It depends on the project. I mean, we've done smaller single family projects that, all we need is maybe $500,000
Mhm.
to larger. Right now, we're working on a 300 unit apartment building and we need to raise $20 million. Return, we're projecting about, for LPs, high teens, low 20% IRRs. Typically, when I talk to investors, unless they're institutional investors, I don't quote IRRs to retails. My target is usually double your investment. So
And
what I
over how
say
long?
is, what's that?
Over how long?
Over the period of the project. So
That-
from this,
Like it's like a
fr-
2 year,
fr-
3 year.
so development cycle is typically 3 to 5 years. 2 years to build a building, 1 year to stabilize. If everything goes well, we sell it after 3 years. We may want to hold it for another couple of years. So we're saying be prepared to have your money locked in for at least 5 years.
And do you go to retail investors or do you go to larger single provider, single check writers?
Both. So for the 20 million raise, it's not a 20 million project. That project is actually a $100 million project.
Mhm.
And so we're looking to finance it with 30% equity, so roughly 30 million, and then 70% debt. Sometimes could be 35 to 65 in this market. And so what we do is we use retail investors for the GP side. The rest of it, 2/3 would be institutional LPs. So
And
sometimes it could be institutional LP and pref.
and the reason I'm asking this is because, with a lot of the multifamily investments that we've worked on, I've been, and I've talked about this on several podcasts, but I really dislike the degree to which multifamily returns have been compressed to such a degree that is a detriment to the investor is my real stance on it. I think that a lot of retail investors have not understand the true risk that they're investing in regards to a multifamily market. In the multifamily market, it's been so compressed that cash flow used to be a relatively normal thing. And, in the return on cost metric, or, I'll even call the cap rate, you're talking about an A-class asset where rents are topped out on a property. Those traditionally were assets that were lower leverage assets, but the rents were topped out. So you had between a 7 and an 8 unlevered IRR on a hold period for an asset. You're going to get some appreciation, you get some gain over the hold period, but you're not really doing any work to really improve the asset. And once you lever it, you can get it up, maybe 2 percentage points, maybe 3, something around a 10 for a core asset, something's brand new. And then once you get to a core plus or somewhere between 10 and up to a 14 for a value add, and then for a value add project that's north of a 14, that's where most investors haven't truly recognized how much risk there really is in those assets. Why, for such a high teens return, to really look at it for what it is. Junk bonds they perform great, but they have a higher risk profile. And as a result, a higher return that they're offering. And for value add multifamily, those pitfalls exist also. And for a lot of us that are even in the industry, when markets correct, adjust, have a period of time where they're rebalancing to kind of create some of that cash flow that used to be in existence, there's an awakening of it where it's kind of like, oh my gosh, most people over the course of the last 10 years had the wind at their back in regards to compression of cap rates. Everyone in the industry for real estate, some amount of risk. We go, hey, how much risk are we going to accept in regards to going forward with this project? Those things, once the market flips, become all magnified. Every one of them becomes magnified. For us as an organization, relatively young organization, 99% of the deals that we looked at through 2021 and 2022 didn't pencil. I mean, it was almost all of them. And the ones that did were still highly competitive. It was still one of the situations where when you'd submit an offer, the received offers from that period of time were significantly higher. And if you wanted to compete, you had to raise your price. Generally, I just looked at those things by now, this isn't a good investment. And the stabilization of an asset, which I'd love to hear this, but if a lease-up occurs in an asset, if you're starting at some point with a 0 tenant base, that the lease-up doesn't happen once, it happens twice. Because there's a period of time where the management is getting people into the property and it's vacant. So they have to work with who they can get to fill the property. They will get more affluent individuals, but they're still going to have some mass percentage of them that were renting a property that was vacant. Then once the property is fully leased, when now you're able to start pushing rents, be more selective with who you're able to let in, raise the bar for your rental standards for whoever you're allowing to live at the asset. Once that happens, you might have this period of time where the original tenants might not look as originally favorable as they once did. There was a project I was working on in the Phoenix market, and this was absolutely what occurred. They had the new groups who were looking at it, got the ledgers from the developer, and it was like 50% of them were paying their rent. They paid rent for 3 months, and then after that 4th month, they weren't able to do that. So it was kind of one of those processes where the new groups were really trying to figure out how to even pencil, make the deal work, and it was below the debt value and value. So
Exactly. Well, so a few things that you mentioned there, and that we've seen that kind of dichotomy, the return expectations and risk, different groups, even institutional groups, are having this interesting attitude towards returns. If you present a project with low 20s or mid 20s IRRs, they would look at it and be like, it's not realistic. And they don't want to look at it because it's too high. Even
too
though
aggressive.
you're like,
It's
look,
too aggressive.
they think the returns are too high, even though it's an apartment building, right? But maybe we got the land for a good price, good economies of scale, ways to save by structuring it in a certain way. If the projected returns are too high, they don't want to look at it because they think something's wrong. On the flip side, if you're presenting a project with low teen returns on an ERR basis, it might be too low. It could be the same project, just presented differently. Maybe the capital stack is arranged differently, and therefore the numbers are different. They have these benchmarks they look at. It's hard to guess what they want. So a lot of times before we pitch the project, we have a conversation and understand what their benchmarks are, what they're actually looking at. With retail investors, it's all over the place. Some people think that development is easy, and especially on residential side, a lot of people that we talk to in our businesses, we partner with property owners. So we tell them, look, we can help you develop the property because we know how to do that. And the most common rebuttal we get is, well, why do I need you? I can just hire a builder and get it built.
Yeah, it's just
Well,
that easy, right? Just no problem.
And then they're like, we don't need to split our profits. We can just make all the profits. And our rebuttal is, how do you know you're going to make a profit? Just because you got what they call a bid from a contractor, I'm using air quotes, doesn't mean that you can actually get that. If you've never built a house, if you don't have a list of specs, if you just bought a stock plan, you have no details, your contractor is going to give you an average price per square foot, and the actual cost could easily be double. If
Not
people
more.
don't get that, the risk perception is completely skewed because they don't think there's risk. They think it's easy. Hey, the market's been great, and it's easy. Right now, when the market is not great, they don't want to do it anymore. I just recently saw a listing locally, and it's funny how they listed the property. It looks like they're selling a house. There's plenty of good-looking renderings, and the list price is, I forget, something like $1.6 million. I'm looking at it, I'm like, oh, that's a good price for a house. And then you start reading the description. There's no house. It's just the land with permits
Oh, really?
that they're selling. So they're selling land with permits for that price, which normally I would pay for a piece of land in that area, maybe about $1 million, up to 1.2, depending on the size. They're selling this for 1.6. So clearly they're trying to take some profit up front, and then you're forced to work with their builder. It's not a builder selling, which is what I thought, because a lot of builders are trying to do that, doing these pre-sales. But it looks like it's a private owner who hired an architect, got the designs, and now they're trying to sell it with a builder to build a custom home.
Are they going to sell it for that price?
This market is so unpredictable.
Yeah.
Right now, Seattle area especially it's got this weird mix of newcomers, folks that are flying up here from California, where prices are so much higher, and they look at it and see a deal. And we're looking at it and we're like, this is expensive already. I'm looking at it, I'm like, why would I be buying this piece of land? Yes, it's got some permits, and I don't know if they have permits, but they have plans. And
There's a relatively large amount of value in regards to selling something to someone where the other person doesn't have to learn. And I mean that. If you go, hey, the permits are here, but the idea of getting permits is so daunting to some people, where it's like, whoa, I've got to go through this process, do this thing. Yeah, we don't do development because when I look at what we would have to really learn to become an expert like you. It's a big learning curve. And I think that's what a lot of people are trying to figure out right now in regards to compressed returns and what they want to do. We're in a dearth in the market right now in regards to transaction volume. And a lot of pricing in the market right now is being readjusted in such a way that people are considering other things. You look at a house and you go, hey, this guy's already done this additional amount of work, but instead, it's exactly what you say. You buy it for $1 million on the cost of getting the permits for the place. Well, let's ask that question. So you find a piece of land. You pay how much for it, you said, for a piece of land in that area?
I would probably pay up to 1.2.
1.2. And then for the plans and permits, what would that cost?
That could easily cost another 150.
Okay. So you're up to 1,350. And then, so this guy's trying to market that property to make approximately 250 profit. We don't know what he bought the land for, do we know?
No, we don't. Well, yeah, I don't know the details of what they actually including, if they have the permits or not. But here's the thing. You could buy a set of plans for $5,000
Okay.
that a builder would take and be able to build. That set of plans would have no specifications, would have no interior design, would have no finishes picked out. And the builder is going to look at that set of plans and said, well, the last house I built, I charged, $400 a square foot. And an inexperienced client would come in and say, hey, well, I thought I talked to a couple of builders and they quoted me somewhere around 250, 300 a square foot. Why are you at 400 a square foot? And then the builder would say, okay, well, I could try to do it for 300 a foot. And then they start construction. And as they start construction, they start moving the dirt. And all of a sudden, it's August. By the time they start, it's going to be November. And what happens in Pacific Northwest around October time, it starts raining a lot. And the dirt gets wet. And then they come back and say, well, when we priced it, we didn't anticipate wet dirt. So here's a change order.
Yeah, and there's always,
Right?
yeah.
So here's a change order. You pay that and you're like, okay, well, I could maybe tolerate another $50,000. It's a lot, but let's keep going. They keep going and they're like, okay, well, we framed the house. You walk through the house and you're like, ooh, I don't know. I don't think I like this kitchen. It's a little too small. Can we bump the wall? The contractor says, of course, not a problem. Let me just call the structural engineer to verify that. Structural engineer charges you another couple $1,000s to recalculate. Then you have to submit to the city to approve. Then the contractor says, well, because I already built this wall, I need to take it apart and then I need to reframe it. No big deal. It's going to be another, like, I don't know, $5,000. You're like, okay, fine. Well, now you just spent $10,000 on 2 months of time.
To move
And the house wasn't, right? And it's like that every other week. Then they say, well, we priced the cheapest possible siding. And you're like, I hate that siding. I want something else. And the contractor says, fine, no problem. Here's a price for something else. And then appliances. And then finished.
Yeah, I think that's been the hardest, on any project that we've ever been a part of, it's making sure that we're getting 3 bids, is making sure that we have encapsulated everything into that bid as possible, that we tell the contractor, we don't want the contractor to come back and go, oh, we can do it for this price. We want to have the materials picked out. We want the tile design picked out. We want everything. So in fact, we generally start with the designer so that we have every material, every wall already organized in such a way that by the time the contractor receives, what the plans are, we are not having change orders. We've done renderings to hopefully pay to get some of these things that you're talking about corrected in advance so that we don't have the change orders. But we force the decisions based on numbers versus our own personal vision. Because if we look at something and we go, oh, well, the siding looks like this, but we comped it out, we did it knowing that other properties that had the similar siding sold for X price or whatever it is. Well, it doesn't matter if we like it or not. The comps show that siding worked for whatever the exit price was. When for the contractors we've worked with, there's some things that a lot of people might look at and go, oh, well, the cost for the tile. This tile is the one I have to just think about very specifically because I got to do a conversation with a contractor about this. But, a contractor will quote, will call it whatever their base level tile price is to their sub on a square, 5x5 inch square, 12-inch square, whatever it is. And you show up with a pattern design tile, something that's floral, something that's not square design, it's trapezoid, it's a rhombus shape. For those people who have gone back to geometry, something that's not, all right angles. And all of a sudden that cost shoots up. But the contractor didn't quote that, but his sub to him did quote that when he actually was out to do the work. The contractors are the ones who, because they're subbing out their work, are constantly trying to cut every corner because that's how they make their profit at the end of the day. And as a result, you got to keep your eye on. I hate to say it like that. I don't want to exhibit distrust, but with contractors we've worked with, we found work that was done that we had to say, hey, this doesn't match the plans. Why'd you do it like this? And then they had to rip it out and put it back in. On a couple occasions with stuff.
And that's super important is to have those plans. And I see it all the time. When you get especially when you have a big building, your set of plans is a giant book. And, there could easily be 500 sheets of different trades. And you think that because it's a large set that all details are accounted for. And then you start going through them and there's a ton of holes in them.
Yeah. You're right. Yeah, a ton of holes. And I've worked personally with very large organizations where the override budget for all of the projects are in the 7 figures. And the company's looking at how they're going to, cover that. And in many ways they will, but it'll take however long it takes for the cycles for real estate to help them sell their assets at the right time. And as, I'm sure you're aware, the entire real estate industry doesn't have money together. And that's the funny thing is I was talking with these guys. We had this meeting where we were talking about the great financial crisis. And they're like, oh, this price for a house back then was this, man, I would have been buying everything. It's always the response. Oh man, I would have been buying everything. And they forget the reason the markets drop is because no one has money at the same time. If they had money, right, the prices wouldn't have dropped. People would have paid the number, but when no one has money at the same time, that's when that occurs. And actually, Eugene, let me ask you this, because I am curious your thoughts on this. Do you think the stock market's going to crash or do you think it's going to stay?
I don't think it's going to crash. I don't think we'll see a giant crash like we have in the past. It's definitely going to decline. It's interesting what's happening right now. First, we've got election year, right?
Record highs right now.
Right. And then everybody's talking about rate cuts, which, we in the real estate industry, we're all waiting for those rate cuts, right? Because we want those cap rates to compress, we want the borrowing costs to come down. But rates don't come down unless there is a recession. Recession means unemployment is high. Recession means banks aren't loaning money.
Means no one has money together.
No one has money. And it's interesting because it seems like there's still money out there. So I'm looking at it and I'm like, inflation is still not down based on the latest reports. I personally don't see, I know that the rate cuts are priced in by a lot of smart analysts that are way smarter than me. I don't see it happening. Not right now, not in September anyway.
Michael Brewery, the guy who's featured in the movie, The Big Short, his commentary was, and he said this a year ago, and I would have already believed this before I even read his article about it, but it was that they're going to have to reduce rates because they're going to want the economy to look a little bit better. And as soon as all the inflation rushes back, they'll have to spike rates again. They'll have to shoot them up. I just disagree with everyone that Kamala has brought up regarding, I'll call it anything that's handing out money. Reason being is because it's being printed. They're printing more money. This is all further inflationary. They keep talking about how they're going to reduce prices, but all the measures they talk about that are structured or to reduce prices are things that will cause prices to go up. And then Trump's comment was, drill baby drill is what Trump had said. For a lot of people who dislike Trump, he's an easy person to dislike due to his brash nature. Just saying, as far as the media goes, he's an individual where everything comes out of his mouth because it's all so salacious. But at the same time, stimulating the economy of further growth is the best way to have dollars further moving through the system. And really what needs to occur, which is raising wages and through organic growth. And I think that's the biggest thing that the country has, there's always this kind of conversation regarding, lowering costs versus increasing wages. And they're not the same, because one actually requires there to be a work ethic attached to it where people are pushing and they're working. There is no ability ever for money to come from not having a work flow occur. And that's just, when I look at this dichotomy in the country right now, I'm just so shocked at the way that there's so many individuals who just have this expectation that the government can print money forever. I'm just blown away by it. And the reason I'm bringing up the economy, the real estate assets in general, if the stock market drops 10%, 15%, whatever that number is, and all of a sudden there's, hey, do you want to invest in this piece of real estate where you get a 15% gain, but they've got to sell a stock at a 50% loss? They've got to move money from one asset class to another. they're just going to be stuck in a lot of those assets for a prolonged period of time. And I think that's why for us personally on this side, we're relatively in a holding period when we want to be focused a lot more on core and core plus assets for the foreseeable future. We really do.
Right. That makes perfect sense. For us, the way we're looking at it is because it takes 3 to 5 years to get a building built, depending on your cycle. Whatever the state of the economy is, I think everybody would agree that the economy is cyclical. And I think everybody would agree that maybe we're not at the bottom. Maybe we have passed the bottom. Maybe we haven't reached the bottom yet. But that bottom is going to be way behind us in a rearview mirror in 5-year term. And that's why when we're talking to investors, we're like, look, you're not investing on.
I was going to say, how do you price that in? Because I'm always curious about this. So please educate me.
There's no real way to price that in. I mean, you're still looking at your risk. What is the risk that this is going to fail? So you've got two major obstacles here, right? You could lose all your money, or you could lose 5 years and get your money back, but no growth. Second one is not as bad as the first one, but still not ideal. As long as the project is well capitalized and there's enough margin there to avoid the total loss, that's one way you hedge it. And then if you are not able to make a return within the time frame of the project because the economy didn't recover or something else happened or some local events happened, then with real estate, you always have the advantage of time. So like 3 years.
And how do you mitigate that time in regards to debt?
Correct. The only way is to have enough equity there so that if the values aren't getting to the levels where you want them to, or, like what happened in the last few years, interest rates went up. The reason a lot of projects were upside down is that they didn't have enough equity in the deal. By the time the project got done, they need to pay off their construction loan, but the permanent loan doesn't price as high to pay off the construction debt. So now the projects are upside down. They need to raise additional equity. So the way we mitigate that going forward is we make sure that we've got enough equity to begin with. We underwrite to the most conservative takeout. And as long as we have enough equity to have a reasonable spread, even if the interest rates continue going up in the future, we still stay fairly protected. And so that's the only way to mitigate that.
Okay, so you're like, hey, this building be built in construction date, completion month 48, stabilization 1 year.
Sure.
And you get out to that year 5 mark and you should be leased up. What is your DSCR to your construction debt at that point?
So we underwrite DSCR to the takeout debt.
But the reason I'm asking on the in-place debt. So how much risk is there on the in-place debt for that number? And what is that on the takeout debt also? Because you got to make sure you're covering your construction debt, and then you got to make sure you're covering the takeout also.
Sure. Yeah. I mean, on a takeout, I guess in the model, takeout will refinance the construction debt. So the dollar for dollar is going to be about the same. In some cases, if the property appreciates that much, that you could refinance construction debt and have some cash left over, which was the case in the previous, decade. That's how a lot of investors got cashed out, is by the nature of refinance. But we don't do that. We don't underwrite it like that. So takeout debt is relatively similar or the same to construction debt, and the DSCR would be minimum 125.
Okay.
Yeah. Now, the HUD, the government has interesting programs, which I've looked at for so many years, but we never got around to do it just because they're so slow in approving it. We're back to looking at the HUD financing right now. The interesting thing about HUD financing is that it's construction to perm. So you get one loan, they cover the cost of construction, it's interest only during the construction, and then it automatically rolls over into a permanent debt with a 40-year amortization. The advantage is that minimum DSCR is, I think, 1.15 or 1.17, something like that.
Okay. And within those DSCR figures, and you're saying that's on the takeout debt,
sure, refinance is always built into the model. It doesn't necessarily mean that we have a lender in place before we start construction, but
how do you forecast that takeout rate at that time? Because this is one thing, and I'm asking because if a guy started a construction project in 2020, he got the cheapest debt ever. He got a 3% rate on his construction, and then all of a sudden it's time to refinance, and he's 280 basis points over the 10-year, and he's like, shit, my DSCR was underwritten at a 3 on when I did the deal, and now I've got to be at a 1.25 on a 6.5% rate. So how do you guys look at that?
Yeah, that's the tricky part. We do build a sensitivity analysis. Normally, the default is we use current rate plus or minus, maybe 50 basis points. Historically, that's been sufficient. Obviously, a lot of projects got into trouble over the last few years because of that, because the rates went up so rapidly. I still consider it an unprecedented event. I don't anticipate rates to go up by that much in such a short period of time.
See,
So that's why we built the sensitivity model.
yeah, but that's kind of my concern with regards to short-term rate decreases and the potentially if, prices shoot up again. I'm very
Mhm.
on the outside. I'm very concerned about the devaluation of the dollar. But at the same time, part of me looks at everything in regards to real estate and I go, we might be paying $20 for a cup of coffee by 2030. Really, that really could be the case. In fact, I was in Encinitas last week and the coffee shop I went to was charging $9 for a cold brew. And I think it was $6.50 for one of their specialty pour overs, which was all they made. They did not have a regular drip. And I was like, my word, it was expensive. I couldn't believe it. I was looking at the pricing going, whoa, like we're already, almost there.
I'm catching myself sounding like a grandpa. Like, oh my God, I remember when I paid $1.50 for a cup of coffee and now it's $7.
Plant a legacy.
When I was a kid, I actually had a pedal powered bike as opposed to an e-bike. On your sensitivity tables, how far up and how far down do they go? And you're talking about not an exit cap, but on rate for your refinance. How far out do those sensitivity tables go?
I typically model them 1.5% up and down
Okay.
at like a 50 basis points increments.
Mm-hmm.
Just to kind of see. I typically play around with those numbers. But it's funny, it depends on who I talk to. Retail investors, most of them don't know enough to ask that question. Institutional investors don't care. They have their benchmarks, they have their own models, and they basically take our number, put it into their model, and work with that.
Got it.
It's understanding of risk. What risk am I comfortable with? What risk is the investor comfortable with? I feel like I need to know the model well enough to be able to explain what the risks are. That is the biggest challenge to me is some people are super risk averse and they ask all these difficult questions to understand and to assess their risk. And then others think that it's a slam dunk. And then we need to slow them down. Hold on. You got to understand what could go wrong. But at the same time, I don't want to scare them, because obviously I want to work with them.
Plant a legacy.
It's the reality of being an investor, right? On the sponsor side and on the LP side, it's seeing these things and deciding at what level that risk is, appropriate. Because we all know this. You could risk yourself out of investing forever. I mean, you could look at every deal and just go, hey, they view it as a poked hole when in reality, that's the reality. Like we are in markets exist,
Right.
Inflation could exist, wars could exist, these events, the GFC, these collapses that have occurred over different time, whether it's the tech bomb or whether it's the GFC or whether it's inflation we're seeing now, or this back you go into a savings and loan crisis. I mean, there's just so many different times where the reasons that these things occurred is because you couldn't really see them. So people have this expectation thing they can fully risk adjust deal and it's just not
Right.
possible.
Plant a legacy.
Well, what's interesting, you mentioned about politics and fiscal policy. What's interesting to me is that fiscal policy rarely follows or corresponds to the right actions of the monetary policy. Like, I think most of us trust what the central bank and the Fed is doing as far as regulating money supply and regulating interest rates to adjust the flow of economy. But what the regulatory body does, the lawmakers, they seem to live on their own little island, and all of their policies are geared towards the next election cycle. They don't care about. The only exception in the history that I remember where that was not the case is COVID.
So let me ask
Actually, they got so scared that finally the fiscal policy and the monetary policy were, for a short period of time, they were locked in and doing the same thing to achieve the same result. And then, of course, they printed too much money.
My biggest gripe with the way they handled COVID PEE funds or whatever they were calling these zero interest loans, loans that were completely forgiven. I mean, they just sent money to people. I mean, if you really look back and think about how bonkers that was, it was the most frenzied sending out of money ever. And I'm pretty conservative. And I'm just looking at that going like, what were they thinking? I mean, in hindsight, the only stimulus that should have been sent out exclusively should have been for rent payments. That's it. Your home rent, your home mortgage, because that's all it came down to. There weren't food shortages. There weren't shortages of people doing the only thing that we're concerned about was people not being able to afford their living accommodations in your computer business. As a result of having everyone work from home, guess what happened? The entire office market is in the toilet when they figured out people didn't need to go back to work. The US government goes, all right, everyone work from home. And now they're shocked that the office industry is crumbling because people figured out that they could do 90%. I'm a believer that you work better in an office. Collaboration is better. Working with senior people is better because you have access to them to learn things, to do things. For me to teach a junior individual, being in the same location matters for communication, getting deals done. Every time that me and my business partner have meetings that were in the same location, we always are fantastically more efficient. But I'll tell you, we have several employees that work in the Philippines right now. We have several employees that are in the Philippines doing work. We've hired in Venezuela. We've hired in the Philippines, and they are fantastic. They're eager to get work done. They're all highly intelligent, highly trained people. And, when I look at what the playing field for the world could look like as a result to work from home or work anywhere in the world, it's really shocking. And Eugene, I got to ask you, should we have gone off the gold standard?
Should we have gone off the gold standard? Oh my God, it was so long ago that I think we're all kind of adjusted our thinking to that. Yes, I don't think gold standard matters. And proof to that in today's economy is crypto, right? It's made up.
But crypto is relatively gold, right? I mean, you can't counterfeit it. There's only a limited supply of it. It's finite. And compared to US dollars, you kind of realize how much the US dollars are monopoly money. They could print as much money as they want. They charge us taxes, but they can print it. They can send it anywhere they want in the world. It's almost tracked on a digital basis. I mean, they want to know everything we're working on, where any dollars are spent or what we're using it for constantly.
But it's still made up, and gold, you could potentially dig up more gold. It's not like we have a finite supply of gold.
Yes, but it's expensive. How expensive is it to dig up the gold? And that is the cost benefit to gold is that. And when I'm bringing up gold, I don't want to argue that gold is the best thing ever. But when we're talking about inflation and we're talking about these factors, these are factors because we're talking about the Fed and the Fed is doing what's best interest of the population. I believe so, but within a system that is created out of money from thin air that we have to loan to other people to pay back money that the US government also has the capacity to print out as much as they want of.
Right.
And it's, and that's when I look at it and go, gosh, this entire system is a little more fragile than we kind of believe, especially when you look at what's going on with BRICS and some of the other international currencies.
Oh, that's for sure. That's for sure. One thing you mentioned early in the conversation is that you don't do new construction, you don't do development because it is complicated and you don't know enough about it. But what makes you think it's complicated?
I mean,
what makes you think that?
Just haven't done it. I mean, I'm not saying that I couldn't do it. I'm just saying that, especially for a big project and especially if taking other people's money, I want to partner with you. Really. I mean, that's the reality. If I was going to do a project, I would want someone looking over my shoulder. I know enough to be dangerous with a construction project. I definitely have been through enough to work on them. But when you really are collecting money from other people, you have to have their best interests in mind. And I have seen other people. I sold a deal to a guy a couple of years ago and we offered to partner with him on the multifamily asset. He wanted to do it on his own. And it was myself and two other sponsors. We were going to have the four of us team up on this one particular project and do it. And we had this one guy who really wanted to branch into multifamily. And he kind of said, no, guys, I want to do this myself. Sell to me. I'll buy you guys out and it'll just be myself. And I did. And I sold it to him. The guy had never done a multifamily project before. And it went very badly for them. And I, as an outsider, saw it. And it was kind of one of these things that was like, it was really, especially in this economy, when you want to make sure your I's are dotted and your T's are crossed, I would partner with you. You said, hey, I got this project and, we raised capital for this. Hey, let's figure out how to get this done. I would come in with you on a capital raise basis and I would have an opportunity to be on the GP team to look over your shoulder, learn everything about it. But I got to say, Eugene, even then, if I was to do my own project, it would still probably be a geometric RE project where I still have a Eugene Gershman or Eugene Gershman equivalent skilled individual overseeing the project. You
Right.
still, whatever that means. And, and there's always this, people have a unfortunate view that, they want to be a home run retirement kind of thing. Hey, I'm going to do this one deal. I'm going to make $10 million and then I'm going to retire. The reality is it just doesn't work that way. Your career is built over lots and lots of deals and you want more singles, doubles, triples, and home runs. But will there be a strikeout in there? Yeah, probably. To be honest, you're in the industry long enough, you're going to have bumps in the road. But my point is multifamily, I believe for the way that you're doing your construction projects, it's a team sport. We bring in an asset management team. They get a portion of GP. We bring in a capital raise team. Generally, that's going to be myself. They're going to get a portion of GP. We're going to bring in other groups. Can be the construction. We want to make sure they're on top of it. We're another group that's doing, whatever those roles are. And, the same thing applies. When you say, would you do one yourself? To be the lead sponsor on it, where I'm finding it, underwriting it, and going through it, that would be that. I don't know what that would look like right now on a cost time basis. Because a lot of people, someone sends me a multifamily deal, I can have it underwritten in 5 minutes. I can look at it and I can tell them within a 5-minute look at a couple of different stats if it's worth spending time on or whether or not I should move it away from my desk. And with a construction project, I'd be on the phone with you, a lot.
What are you working on right now? What's your main objectives right now in the next 6 months?
Capital raising. Capital raising, and then we have a tech product that we're working on that's been a very major portion of our business. That's the reason that we've done the outreach for the Real Estate Dads podcast, which I've been really proud of. I didn't realize we were going to have such a community service. We've connected a lot of dads. We've gotten a lot of individuals to reach out to certain people who are dealing with certain things. I was talking to someone last week and I told them about your daughter's maneuver about getting your wife to put in the code of the phone. I thought that was just such a hilarious story. But that podcast has been an outreach that we've been able to get in front of some really great contacts. I'll include you in that. We've got these contacts from people that we were able to talk about something a little more in general rapport. And as a result, build a little bit of a relationship could turn into something more. That's been the same thing for our guests. It's been the same thing for people who've reached out to us who are saying, hey, I'm interested in what you're doing. I'd like to be a guest on your podcast. And, and now we're doing our first capital raise via that channel. So those are things that have been really great. And we're going to continue building that momentum. And right now, I talk to a lot of guys who are still doing deals right now. I'm pretty bearish for the next 12 to 18 months. I really am. We just look at the economy and real estate has long cycles and it's pretty wrought with potential risk at the current moment. And that's part of the reason why Core and Core Plus, we're looking at buying. We want to work with investors who understand risk adjusted returns. And as a result, understand that when we have we call it a 10 to 12 IRR, it's because we have a really secure 10 to 12 IRR rather than a high teens IRR that's loaded with a bunch of risk. And a lot of investors are trying to understand that in the market.
Max Gonzales, thank you very much. Thanks for your time. It was an excellent conversation. Let's stay in touch.
Eugene, always so glad to be here. And I'm looking forward to hearing about your project and figuring out how we can do something together.
We'll share the information. And if anybody wants to reach Max, we'll have the contact and the description. Feel free to call Max, call us if you have investment projects to look at. We're available.
Awesome. Thanks, Eugene.
Thanks.
Real estate development.